In terms of order types and transaction execution, obviously a currency broker is a lot more flexible. You offer obviously market rates limits, stop limits, and stop entries. Can you just talk us through what those specific order types are for you? So, for example, if we do a market order transaction, a limit transaction, and a stop entry transaction, and how those orders can be used to help customers manage better foreign exchange executions.
Yeah, fine. So if a limit order can be very good in terms of a client looking to achieve a better rate of exchange. What a client can do is if you look at, say, to keep it simple, sterling euro rate of exchange, over the course of a day it can move between two prices and it tends to bounce between those two levels. So what's always good is to try and catch it at one of the highest prices of that day. So what a limit order can actually do is you can place an order in the market towards the top end of that range, and it's what we call a GTC order. So it's good till cancelled. It stays in the market for 24 hours, 7 days a week. So it covers the overnight market as well. And as soon as that level is actually achieved, it automatically buys for you. So it's actually a firm order placed in the market at that pre-stipulated level. If the price hits it for more than a second, then it automatically buys it for you. Mm-hmm. So that's on the top side. You touched on there is a stop loss order, which is the reciprocal of that, which you can place on the bottom side of the market. So essentially what you can do is if you're an individual who's sold a property in the UK looking to purchase overseas, then you can place a limit order in the market above where the market's at. And if there was some concern about sterling depreciating and the price collapsing, then what you can actually do is place an order above the market and below. And what that basically does is it ring fences the market for you. So if sterling was to depreciate aggressively further, you've got a stop loss there, safety net. But if the price does go higher, then it automatically fills it for you. So essentially what you're doing is preventing any too much downside risk, giving you a chance of some upside potential as well.
Perfect.